Welcome to the Major League Real Estate Podcast, a podcast for operators of large-scale real estate portfolios. My name is Nathan Sosa, and I'm your host. Together with my co-host, Matt Hamilton, we talk about tax and legal strategies, and we bring on operators of large portfolios for in-depth discussions on how they grow their business. We hope you enjoy. Welcome to another episode of the Major League Real Estate Podcast. I'm joined here on his return from paternity leave, Matt Hamilton. Everybody, welcome Matt back. We're super glad that he's back. He survived the month one of fatherhood. Matt, tell us a little bit about the experience of being a dad and how the sleepless nights are going.
It flew right by. I'll tell you that. I was surprised to learn how little sleep you actually need to operate. And I will say, I think I went a solid month without getting a solid REM cycle in, because that's the hard part, right?
Yes.
Like I'm getting like a lot of sleep, but it's just all interrupted. You're like sleeping like 1 to 2 hours at a time, and it's just like, but it's all good. It's all good. My first day back, my wife actually, like, she handled like all of the feedings and diaper changes like all night, and she just let me sleep like all night without me waking up. And it was like the first like full night's sleep I got in like a month, and I felt like a new person. Like the day, like I woke up that morning and I was like, what happened? What did I miss? And I don't know. It's crazy, but yeah, no, it's going great. Couldn't be happier. Happy to be back, and it's going great.
We're glad to have you back, Matt. It's really great to have you here. I know, like, okay, maybe this isn't podcast appropriate, but any poop stories you got for us?
No poop stories, but I will say that one of his favorite pastimes is to immediately poop in a fresh diaper.
Of course.
Like I change him and then he just immediately poops again.
I think that's actually, that's one of the hidden things that no parents mention, but all parents know about. And they're just like, oh yeah, that's like, they'll just become part of your common life. Every time.
Yeah. Like every time I go to change his diaper, I'm just like mentally prepared to like change like 2 or 3 diapers.
Yep. And that'll be the rest of your life until they get out of diapers. So another 2 to 3 years, right? So just
Can't wait.
Oh man, would love to hear anyone else's fun parenting stories that they have to share with us. But so today is actually, speaking of sharing, today we're doing our first mailbag. We want to do a mailbag, questions that we've gotten from the audience and from everybody else who's just written in and listened to us. And thank you so much for writing those in, everybody. And so today, it's going to be a little bit shorter of an episode, but is to answer some of these questions in an explanatory way, right? And not like a long in-depth. Some of them we could obviously go really in-depth into. We're not going to do that today. We like to do our deep dives, but today's focus is going to be primarily on what these mailbag questions are. And to start, the first one we have is actually a great one. It's like, hey, when should we consider a 754 step-up election? So Matt, what are your thoughts there? When should you consider 754 step up? And actually, when should that be included in your operating agreement?
So I think it probably makes sense to start with what even is a Section 754 election. And basically, whenever you have a partnership that, let's say it owns real estate, what's going to happen over time is the value of those underlying assets are going to change, especially in relation to the adjusted tax basis of the asset in the partnership, because the partnership is taking less depreciation, right? And that's decreasing the basis. So let's say years go by and another partner wants to come into the partnership, they want to buy in. But now, because years have passed, the real estate value is presumably, hopefully, increased. Now the buy-in price for whatever percentage of that partnership is going to increase. So now what's going to happen is maybe 50% of the partnership initially would have cost $1 million. Now 50% 5 years from now costs $2 million. So this new partner is coming in, and that discrepancy between what's referred to, some tax lingo here, as the inside basis of the assets is going to be different than what the fair market value is and what this new partner is coming in for. So that's just kind of the discrepancy between the inside basis of those assets versus the new fair market value that these new buyers are coming in at. And that difference is where this 754 step up comes into play. So if the partnership, and this is an election the partnership makes, if the partnership makes a Section 754 election, what happens is there's actually the value of those underlying assets is stepped up for those incoming partners, and it effectively allows them to receive depreciation on that step up in basis. So that way they're not out those additional depreciation losses that they'd be entitled to if they would have just bought this asset outright at that new fair market value. So without making that election, you wouldn't be seeing those additional what are called Section 754 deductions allocated to those incoming partners on their K1s. And oftentimes, especially with really sophisticated investors, let's say it's like private equity firms coming in, oftentimes they will require the partnership to make a 754 election before they agree to even contribute the capital in the first place. So that's kind of what a 754 election is, when it's kind of relevant, and sometimes when it's absolutely necessary to even close the deal and get that incoming capital.
No, it's great. Yeah, just a quick recap on that. Basically, 754 election, there's two different kinds, 743, 734. Essentially, one is if you've got an outside partner coming in. The other is if the partnership itself is buying someone out, right? So, and there's 734 is another situation too, right? If you distribute someone on property, it's outside their basis, right? Elections can happen here, right? But overall, basically it just corrects the fact that, hey, a property is worth more today than it was 5 years ago. And if someone comes in, they deserve to get depreciation at that higher point in time, right? That's essentially what it is. That the partner or the parties of partners is worth it. And so once you consider it, whenever you have a new owner, whenever you have some kind of exit occurring, you should always talk to a tax pro about, hey, whether or not you should be doing an election to increase your basis or not, right? Most accountants know or think about it. They should tell you in the background, but it's definitely something that you should look at. And also make sure it's in your operating agreement that the manager has the right to do that, right? Because like that's one thing too. So like that's a little bit more attorney speak, but making sure that they have the ability to make that election. The manager is the one who makes that decision, right? You could have all the partners who vote on it, make that decision. It's a lot of legwork, in my opinion. So better just have, and most agreements are this way, where you just have the manager make that decision ultimately. So 754s are good, thumbs up. However, one thing that I think Matt did mention was once you make the election, you're locked in for life. And so that just means, hey, if you think you're going to have a lot of little adjustments coming up, you have to make sure that it makes sense. Also, you have to have step downs too. Thankfully, it doesn't happen very often in real estate. I've only seen it happen once. It was during COVID. But if you make the election and then you have to go down, you got to do that too. So just FYI there. Once you make the choice, you want to make it on a big one. You don't want to make it on a little one, and then you have to do all the little ones going forward. Would you agree with that, Matt?
Yeah, I would agree. It's very context dependent. Like I've seen some clients where maybe their investor base is on the older side, and some of their investors passing away becomes relatively frequent. And if that happens like every couple of years, I've seen some of them pass on making a 754 election just because it becomes burdensome on the GP because they have to get like a fair market valuation of the underlying assets every single time someone passes away. If you make that election, it locks you into having to do that every single time.
Yeah. So it's good stuff there. Guys, I don't know if you can notice, but Matt has definitely missed talking about taxes and partnerships.
I was thinking about it every single day.
I'm guessing Maxwell's not a good person to talk to about this, but...
See, speak for yourself. It puts him straight to sleep.
Our next question is, if we do a refinance and return of capital, is that taxable to our investors?
The short answer is it depends, which is the answer no one ever likes to hear. Generally speaking, distributions in a partnership are not taxable. They are considered a return of capital and reduce your tax basis in the partnership as a partner. And those returns of capital are not inherently taxable. So if you have, let's say, for example, you have a tax capital account of $100,000, the partnership does a huge refi and does a return of capital, and let's say they return $100,000 of that capital and reduce your capital account to zero, great, no issues. But the issue may be that you receive distributions in excess of your basis, in which two things may occur. One is you may receive more income allocated to you in the partnership as a consequence of that. So you're effectively picking up additional income to the extent you received cash in excess of your basis. Or on your personal tax return, you have to pick up a capital gain because you've effectively received a return of capital in excess of your basis. So you may be hit with income depending on what your basis is, but generally speaking, that distribution itself is not taxable. It just may create additional complications, which is why it's incredibly important to consult your CPA or tax pro whenever you are looking to do a refi and a large capital event inside your partnership that may affect all of your LPs. It's really important to have the knowledge of how this impacts them, because 10 times out of 10, one or multiple of your LPs are going to come back to you and ask questions like, hey, what the heck is going on? Why is this happening? How does this impact me? And how does this impact the amount of taxes I need to pay? Those questions are always going to happen. So it's just really important to talk to someone on the front end so you really understand the implications of what's happening.
No, absolutely. I mean, like Matt and I actually had a conversation with a client that asked the same question today about that. So it's like from top to bottom, it's very important to know the context and like situations, right? Obviously, not everything you do is going to wind up having a tax event, but it just allows for better planning, right? So great points, Matt. Real estate syndication tax is confusing to you? Well, that's why hopefully you listen to the podcast today. Also, you should go to our website, www.therealestatecpa.com, and you will be able to get access to the ultimate guide to real estate syndicators and sponsors, which breaks down everything from preferred returns, depreciation strategies, whether you're a GP or an LP, avoid costly mistakes, and maximize your returns. Download the complete guide free and get the tax clarity you need to succeed. Next question we have is, how do we handle distributions when some investors are investing in some kind of a retirement account and some are not? Does anything get changed from distributions from an operator perspective? What weird scenarios can occur in these instances?
From an operating perspective, in the actual operating agreement, unless it's specified that IRA or tax advantaged account partners are treated differently, they are treated exactly like any other LP. So to the extent all of the LPs are entitled to whatever operating distributions, capital event distributions, all of those IRA and 401k, whatever investors are treated the exact same way. But what's really important to note is that if you have partners that are tax advantaged, like IRAs or 401ks, the K1 that they receive needs to disclose unrelated business taxable income activity. So because they're going to need to fill out those forms and fill out those disclosures on their end. And they can't do that if the K1 you provide them doesn't include that statement. So if you're running a fund and you have these types of investors, it's really important to review the tax return you receive from your CPA to make sure that those disclosures are included on those K1s. Otherwise, you're either going to have some upset investors' CPAs because they don't have the information they need, or arguably a worse situation, you don't hear anything because maybe they aren't using CPAs and maybe they're out of compliance and they're not doing what they need to be doing. So it's just really important to have your investors' best interest in mind and make sure that you are checking for those disclosures whenever you're in that scenario.
Yeah, a lot of times that stuff gets forgotten, right? Some people just don't put it on the returns. It's forgotten, right? Hey, tax prep's a hard business. I know some people think that it's not. There's a lot of things and a lot of disclosures that need to be thought of, taken care of, et cetera, et cetera, et cetera. There's a lot that goes into everything that happens here. So it's a good question. And just like, again, it's like comes down to is like, hey, just make sure that someone's thinking about it or taking care of it. It's ultimately what it comes down to, in my opinion. And so, Matt, this one's kind of an interesting question that like I see every once in a while. And I'll kind of like reduce it. Like it's a longer question, so I'll reduce it a little bit. But like, what are the risks of being audited with partnership audit rules, right? What are the risks? What are the probabilities? I'll take this one a little bit. The risk of being audited from a partnership perspective are kind of low. Now, however, the IRS is actually proposing quite a few things that's going to change that, in my opinion. Granted, a lot of the updates and a lot of things that were going to happen was 2024 IRS. We are living in 2025 IRS. I quite literally spoke with an agent yesterday who a week ago was assigned to an audit of mine. And now he's not. And now he's like, yeah, I'm in a totally different department now. So I don't even like deal with that stuff. Yeah. And so he's like, I'm sorry. Things change all the time. Da, 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 da. Like, it's not their fault, right? They have literally zero power or control in that. But what I will say is that you're going to get stuck if you have a partnership, especially if you're a syndicator and you've got quite a bit of capital. Like we've got a lot of assets and a lot of income. You're probably going to get stuck in the large business and international division for these types of audits. And that's not the division you necessarily want to always end up in because there's a lot less people there. And the reason there's a lot less people there is because they're more experts and they know their things a lot better. So that's not necessarily who I would want to be audited by. Matt, what are your thoughts on all of that?
Yeah, no, I 100% agree with you. A year ago, it was really looking like partnership audit and compliance specifically was really going to pick up at the IRS. And like you said, the tides have shifted. That's not something a lot of my clients are as concerned about now, just with the funding and different directives going on at the IRS. So one thing I do want to point out is what even is this new centralized partnership audit regime? historically, whenever a partnership was audited, and let's say for the sake of argument, there's a partnership with like 10 partners and the partnership itself gets audited and the IRS, let's say the partnership loses that audit and the IRS forces the partnership to make changes to their return. What would happen is, maybe this is an audit of a return from like 4 years ago. What would happen is you would have to file a new version of that return after the audit, and you would have to reissue K1s to all those partners for whatever year, and then they would all have to refile their past returns for that year, and it creates this huge issue. And let's say some of those partners have like a loss carryover going forward. That means they have to refile all subsequent returns too to adjust that number. It becomes a huge headache. So what this new audit regime actually does is it looks back at prior returns and it audits the partnership in a silo. And if there are any changes that occur in that audit, effectively what happens is the partnership would file a administrative adjustment request, or an AAR, and those changes get pushed through to the partners in the current year, in the year in which the audit takes place. So the whole idea is that the way this is meant to be audited reduces the burden on the partners involved in the audited partnership. So that's a positive in the sense that it makes the process a bit more painless for the parties involved. But also, if it's a more painless process, it's easier for the IRS to execute that process in the first place. So, it's kind of the double-edged sword of it. But that's just kind of something to note about what partnership audits look like and how they might impact you, your investors, and what that process kind of looks like.
Yeah, no, that's great points, man. AARs are pains. Not like, like it's like it reduces the burden on the taxpayer for sure, which that's a win. It does not reduce the burden on the tax preparer.
No, it does not.
It is a massive burden on our end to do all that. It's much easier to do a straight amended return and fix that prior year. It's just way easier for us to do that. Sometimes we get into situations where someone's elected out of the centralized partnership regime. It happens rather frequently, I would say. It happens more often than most people do. However, people forget to check that box, and we don't get that easy. But bigger syndications don't get that option because they have other investors, other partners, et cetera, that are investing into it. So they don't get to take advantage of that option. So just FYI there.
Yeah, the big thing there is you're not eligible to elect out if you have a partner that is not an individual. So if you have like an LLC or like some sort of account, a corporation investing in your partnership, then you're not eligible to elect out. And that's where a lot of these larger syndications run into issues.
Great point. I also want to make another point too, is that like if you are investing as a single member LLC or a revocable trust, something of that nature, you still, correct me if I'm wrong, Matt, I think you still get to elect out, correct?
I believe so, because the face of the K1 would still show you individually as the partner.
Right. So so investing via an LLC, an entity, right? Let's say you're a GP, but you want to have a little bit of a liability between you and the property and everything. Totally get that, but you like, oh man, I can't elect out now. You still might be able to ultimately. Just double check, right? Just double check the tax spread on that. All right, Matt, we got 2 more questions left. Let's see if we can knock these out and say, do we have flexibility to allocate more losses to certain investors? Matt, we've talked about this before. How do you get flexibility to allocate losses to investors?
That is a question that seems very simple on the surface, but as soon as you kind of start digging into it, it's much more complicated than it appears. You have all the freedom in the world to go into your operating agreement and just say, I would like to allocate losses to these partners in this way, and this is how all the partners agree to it being done. And that's great. But just because you wrote it in the operating agreement doesn't mean that the IRS would allow you to allocate losses or income in that manner. Because upon audit, the IRS has the ability to effectively disregard the operating agreement allocations and force you to do it a different way. And the substance of those allocations need to have substantial economic effect, which is something, Nathan, you and I have spoken about in the past. And it's basically saying that the allocations that you make in a partnership need to have economic substance. You can't just say that this partner gets all of the losses if they are not taking an outsized percentage of the risk. There has to be some sort of give and take that puts partners in a more, I'll say, disadvantageous position economically that would allow them to take those losses. So for example, putting yourself in a position where you are the bottom layer of a distribution waterfall. You don't receive your return of capital until everyone else receives their return of capital. that is an example of putting yourself in a higher position of economic risk that would allow you to take more of those losses. So the short answer to the question is, do you have the flexibility to allocate losses to certain investors over others? Yes, you can, but it's much more complicated than just writing it in the operating agreement. It's really important to consult your attorney writing the OA. You also need to consult your CPA and have them look over it and kind of work through the process of making sure that those allocations have substantial economic effect and would withstand an IRS audit if it were to come to that.
Yeah, absolutely. That's the key point. We can do a lot of weird, crazy things with allocations, but it has to follow what Matt mentioned, SEE, substantial economic effect. If we don't achieve that, then the IRS will try and beat that up. And look, there are plenty of court cases on this. There are plenty of items that have been discussed on this, et cetera. But if it's not following the true economics, then you're going to have a bad time. So just FYI on that piece. So great answer, Matt, right? And then the next one is, how do we make sure we don't run into disguised sales rules when raising capital? Matt, how is that avoided? And when does that even come into play, actually?
That's a fun one. It's one of those, it's been a while since we've recorded, but I can't remember what the context was. I think we were talking about ticks. It's one of those things where if it walks like a duck and quacks like a duck, it's probably a duck. So, and that's kind of the logic the IRS uses when they're looking at disguised sales. So what a disguised sale is, let's say, for example, you're trying to put together a partnership and one of the partners owns real estate, or they own an asset that they want to contribute into the partnership. The partnership itself wants to acquire this asset and they want to do it through this partner contributing the asset into the partnership. That's all fine and good. But you can't do this in a way where it's just effectively that partner selling that asset to the partnership. And what I mean by that is a quick example. Let's say you have a partnership and partner A has a $1 million property and they contribute it into the partnership. And let's say that the fair market value of that property is $1.5 million. Well, let's say the partnership just happens to distribute $1.5 million of cash to that partner for the sole purpose of contributing assets. What you have there is it's effectively a sale transaction occurring in a partnership. It's basically just a sale with extra steps. Instead of just selling the asset to the partnership directly, you're going through the process of contributing the assets into the partnership and then receiving cash out. And why would you even do this? It's because whenever you contribute assets into a partnership, that process itself doesn't trigger any taxable gain or anything like that. You're effectively transferring your basis in the asset into your basis in the partnership itself. So there's sort of an advantageous method of doing that because that itself isn't taxable. So you can change the flavor of the income you're recognizing if you try to do this, which is why people set up these super convoluted transactions in the first place. But it's just really important to recognize that if you're doing something for the sole purpose of trying to get around certain tax rules, odds are you're probably not supposed to be doing that. And the IRS would kind of look through that transaction for what it is, as a sale or, whatever else. So that's kind of when it comes into play. That's kind of what the IRS is looking for in these sorts of transactions. And, again, and this kind of goes, this is kind of a through line between a couple of these questions. Whenever you're in a situation where a partner is contributing assets into a partnership or the partnership is distributing assets out, it's really important to consult a CPA and look at the ramifications of that transaction, because partnerships are great. They allow you to sort of move assets around, but it's really important to understand that the rules around partnership begin to get very muddy and complicated as soon as assets start moving in and out of the partnership. And it's really important to make sure you have, a tax professional looking over these transactions to see what implications there might be to trying to do this.
Yeah, so actually one of my favorite cases with disguised sales is actually the Chicago Cubs case from a couple of years ago. The owners got nicked for disguised sales rules. It was kind of a mix. It's a good explanation. It's good. It's not really a great decision because they kind of lost. They kind of won in some other areas, so it's very mixed from that perspective. So maybe not the best if you're like, oh, how do I make sure I win this, right? But it's always good to read those types of facts and see how you can achieve that. I love how you said that, Matt. To kind of recap it, is look, the IRS looks at your overall intent with what you're doing here, right? If you throw in a property and someone throws in some cash, and then someone walks out of the partnership with the property, you might not, regardless of what your intention was, it's going to raise some eyebrows of the IRS if they're looking at it. So just FYI there, guys. Well, We would love to have more mailbag questions we're going to do this monthly going forward. So whatever question, like our goal is to like, hey, just answer some of you guys' questions as it comes up, pops up. So you can reach us at nathan.sosa@hallcpa.com. Shoot me an email, matt.hamilton@hallcpallc.com. Always forget the LLC. Matt just kind of gave me a little notice on that. Also, if you'd like to have a conversation with us, check the show notes, click on a link. It'll take us to our landing page, and then we'll jump on a call with you and have a conversation about what's going on, etc. So just let us know. We'd love to chat and work with you. So Matt, thanks so much. We're so glad to have you back. And this has been another episode of the Major League Real Estate Podcast.